Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem and noisy numbers to give you the information you need to make the right trade for your portfolio. I'm your host, Allie Canal, in for Jared Blickery, and with me is Yahoo Finance senior reporter Brooke DiPalma. Today, we're diving into 2025 Q3 earnings season, the big wins, those surprising misses, and retail positioning as we head into a crucial season for retailers to hit the mark with their customers. That brings us to our word of the day, which is retail positioning. We'll tell you what that is and why it's so important in today's record high market. And on today's Market Show and Tell, we're talking about the short-term versus long-term market. Our guest describes one as a voting machine based on markets and the other as a weighing machine based on fundamentals. So what does this mean in practice, and does it really make a difference to know what you own? And our number of the day, 20.8%. That's how much the financial sector's share of overall earnings has jumped, up from just 11.4% last quarter. So what is that telling us about the state of the economy, and what can it mean for commercial and retail customers going forward? Joining us now to discuss this and so much more is Tom Hayes, Chairman and Managing Member of Great Hill Capital. Tom, welcome to the show. And let's start with earnings.
Yep.
We just wrapped up a slew of big tech companies, and it was surprising to see Meta and Netflix both miss. So let's start with your takeaways so far from earnings season and those surprise misses.
Yeah, I think earnings have been better than expected. Estimates coming into the quarter were up 8%. It's been up 10.7%, with 64% of the companies reporting. 83% beat on the bottom line, 79% on the top line. So overall, good. Financials was the largest contributor to that earnings growth, and surprisingly, communication services was the biggest detractor, and the biggest two detractors in that area were Netflix and Meta. And I think that the issue with Meta is a theme that we have to pay close attention to, which is the amount of CapEx spending that we're seeing by these hyperscalers. As a matter of fact, they're now spending in an aggregate group 60% of operating cash flow to CapEx. What does that mean in English? It means they're spending the same amount of money as the large oil companies are now spending in CapEx. And if you look at the multiples of oil companies relative to the multiples of the Mag 7, there's a huge divergence. So we do have to keep an eye on that, because at some point the market's going to say, we need to see a return on all that investment. And for Meta, the market said that this quarter. For some of the others, it may be in coming quarters, especially as we see in the last 12 months from Q4 2024 to Q1 of 2026, we're going to see their free cash flow drop by 43% because they're investing so much.
And keeping on that same theme, we did hear from so many folks that they're comparing this Meta spend to what we saw in their metaverse spending back in 2021, 2022. Investors not too happy about that. So what do you make of that?
Well, eventually...
Does it remind you as well?
Yeah, it certainly does. Eventually, they cried uncle, and they pivoted and they stopped the spending, and the stock went back up. I don't think we're at that point yet. I think they are investing. I think a lot of this is certain. It feels like offensive spending, but I think there's a lot of defensive spending. They don't want to give their competitors an edge, and they want to invest, and hope for those returns down the line. But so far, the returns are not there. The cash flows are declining, and the market is saying, okay, we're going to give you a little bit more time. We're going to give you a little more time, unless the spending is outsized in the case of Meta. And in the case of Netflix, we saw some margin compression, and we are seeing that in certain pockets of the market.
I do want to get to our phrase of the day. It is retail positioning, Tom. Can you start by breaking down what exactly retail positioning is and why it's so important for retailers to keep a close eye on this as they round out Q4?
Yeah, so when we talk about retail positioning, we're talking about retail investors positioning. So this is usually a contraindicator in terms of sentiment. A couple things we're seeing. We're seeing the longest streak of call buying by retail investors since 2020. Okay.
Oh boy.
So they're super duper bullish. And most of those expire in November. So it wouldn't surprise me, because who sells the options to retail is the dealers, the big banks. It wouldn't be surprising to see a number of those options expire worthless. What would have to happen for that to happen is the market kind of chops and grinds sideways, a little bit of volatility before kind of the final end of year push. Then you look at AAII bullish sentiment for retail investor positioning at 44% bullish. That's the highest in months. A number of these streaks feeling a little bit frothy. If you look at the S&P multiple at 23 times earnings compared to the 10-year average of 18.6 times. So everything has to continue to go perfectly right, or these retail investors that have been really getting aggressive in the last few months might see more subdued returns in the near-term future.
Do you think we're at a moment where there's so much spending when it comes to AI, and we talk all the time about whether or not we're in a market bubble or not, if this is similar to what we saw at the dot-com boom and bust, but are we fundamentally different today? And is this maybe a shift in what justifies a high valuation versus a normal valuation? Maybe 23 times forward earnings is the new norm.
Yeah, it could be, because the thesis with that is that tech companies, software companies have always been CapEx light. So now we're going back to CapEx heavy. And are we in a bubble today? No, I do think we're in the early stages of this process. But if you remember in the 90s, there were a lot of shakeouts along the way. It would get a little bit frothy, then earnings would catch up and would get a little more frothy. So I do think in the near term, we might see some consolidation, meaning prices might just have to go sideways. Maybe they pull back a little bit just to absorb all the gains that we've had in a relatively short period of time, kind of get that multiple a little bit more normalized. But the trend is going to be significant. And I think the way to think about return on invested capital is going to be, are companies benefiting from this technology? Because right now it's pretty circular. You buy my chips, you put it in your cloud, you sell it to companies, but companies need to see margins expand as a result of buying these services from the providers in order for this to be sustainable long term. And I think we'll see that. I just think it's going to be a little bit further down the road, and the market's going to have a little doubt along the way.
Tom, what do you make of all these companies? It's so circular. We're seeing that, as you just said, but really with OpenAI, even today, Amazon had made an announcement with OpenAI. It just seems like the focus is so on this one company, which it might go public next year.
Yeah, I think, interesting thing you saw in terms of financing this CapEx, Oracle's CDS spread, the cost to insure their debt, is at 2-year highs. So the equity market is not sniffing it out yet, but the bond market, to a lesser extent, is starting to say, I wonder if this is sustainable. Where are the returns? Because where the debt? It's like President Clinton once said he wanted to wake up one day as the bond market, because the bond market controls everything. When you see Oracle's debt getting a little bit uncomfortable, or the cost to insure it going up, you say, okay, the market is taking note here. Let's start to see a return on all this investment in the nearer term. And if they don't see it, that's where we could get some chop in those pockets. But outside the hyperscalers, outside the Mag 7, literally you could throw a dart and find a company that's reasonably valued under the surface. And these are going to be all the beneficiaries of AI years down the road as their margins expand by implementing these technologies into their businesses.
And that brings us to our market show and tell. And today we're talking about the short-term versus long-term market. And Tom, you described the short-term market as a voting machine based on emotions, and the long-term market as a weighing machine based on fundamentals. So can you break that down a little bit further for us, and how that kind of leads into your thesis of know what you own?
Yeah, I think this is a critical lesson for people, and it comes from Ben Graham, which was Warren Buffett's mentor. He wrote The Intelligent Investor. A great example of this, if you remember, just a year and a half ago, a company called Alibaba. And if you remember, the narrative was China is uninvestable. You can't buy Chinese stocks because of the communist government, because of all the different things. But we looked at it objectively and we said, they've got $80 billion of cash on the balance sheet. They're generating $25 billion a year of free cash flow. They're not going anywhere. They were trading at a high single-digit PE multiple. Oh, and by the way, it was the cheapest AI play in the world. Their Qwen large language model is proven now to be faster than ChatGPT and more effective on several different metrics. And sure enough, right after all the uninvestable articles and all the downgrades in the hole at $60, the stock took off. It's now $160, $170, probably going back to $300 over the next few years. So that's been one of the largest AI performers. Best outperformance this year. No one's talking about it. What's another one of the top AI performing stocks this year? You guys aren't going to believe this. Is Intel. Okay,
well, it's gotten all these investments, even from the government. Just about everyone wants to get in.
But it's such a turn from what we saw.
Well, here's the thing. So Intel was uninvestable as well. So we did analysis. It was trading at a discount to book. So in other words, book value was about $22 a share. It was trading at $18 or $19. We said if they liquidate the whole damn thing and it fails, we're going to get back $22. So our downside is protected and our upside is unlimited. Their legacy CPU business which was in the trough of their cycle, was worth $45 a share. So we'd have a double if they just stayed in business. Oh, and by the way, they're at the 10th yard line on the fabs in Arizona, and they can produce chips. If that works, it could be a 5-bagger. And sure enough, shortly thereafter, the government stepped in and said, we need this to succeed for national security. NVIDIA needs them to succeed because remember, NVIDIA just designs. They don't produce anything. Right. So they're fully dependent on the kindness of strangers, AKA Taiwan Semiconductor, and Taiwan Semiconductor has capped them at $4 billion a quarter of revenue growth. So their growth is not stymied by demand. Their growth is stymied by supply. So the best thing that could ever happen to NVIDIA is that Intel succeeds and can produce chips for them here domestically.
Wow. And Brooke was just mentioning the circular investment, and we just continue to see that over and over. And clearly there's a lot more to come on that front. But we need to take a short break. Coming up, we're breaking down a recent change in the financial sector. That's next. Now time for our number of the day, 20.8%. That's how much the financial sector's share of overall earnings has jumped, up from just 11.4% last quarter. The financial sector is a major part of the economy that includes companies and institutions involved in money management, investment, and financial services. So Tom, you've been looking at the financial sector closely, and it's interesting to see this outperformance considering we've talked a lot about this bifurcated U.S. economy. Yeah. What's your take given the results that we've seen?
Well, what we saw was certainly trading revenues were up, so the volatility was certainly helpful. Investment banking is up. Animal spirits are back. The wealth management business, as assets go up, their fees go up. So on balance, here's a sector that no one was really paying attention to a year ago. And what's really interesting, most people don't realize because all we're hearing is hyperscalers, Mag 7, and all this, particularly in recent days and weeks. Value outperformed growth in Q3. Most people don't know that. Now, that was loaded in August. They outperformed by 700 basis points value stocks over growth stocks, but it carried through to the end of the quarter. And I think this is a trend that we're starting to see. Breadth has been weak, but it's starting to get better. Value starting to outperform growth. Small caps have outperformed large caps. No one's talking about that since this summer, since July of this year.
Why do you think no one's talking about it? Is it just not sexy to talk about those names?
I think it's the weight in the indices right now is so small. It reminds me of energy. If you remember during COVID in the spring, oil actually traded negative, and they were giving away energy stocks because they said energy is uninvestable, pensions can't buy it. It's the green revolution, the whole thing. Exxon traded down to $33 a share. We were buying it hand over fist. You have to buy things. Knowing what you own is buying things when they're out of favor. If you're buying things when they're in the headlines, like Palantir today is going to report, okay? Mm-hmm. It could be great. It could be not so great. I have no idea. Chances are it's going to be great. So they're going to do $1 billion in revenue. Okay, $1 billion. Last time I checked, there are 4 quarters in a year. That's $4 billion in revenue. They're trading at $500 billion. That's not $4 billion in profits. It's $4 billion in revenues. Wedbush was out today saying it's going to go to $1 trillion. So 250 times sales. A lot has to go perfectly right for that valuation to be realized. Because what is a stock? It's just the present value of the future cash flows discounted back, okay? So $1 trillion worth of market cap valuation, it's nowhere near that today. So what happens with these type of Momo stocks is if they hit and exceed expectations, which could certainly be the case tonight, it will continue to go up. People won't care about valuation. They will say this is a paradigm shift. The moment, whether it's a year from now, a quarter from now, tonight, 2 years from now, they miss expectations by 1%, the stock does not go down 1%. The stock goes down 50% because it's like yelling fire in a crowded exit. And Warren Buffett always said, rule number 1 is don't lose money. Rule number 2 is don't forget rule number 1. And when you're playing with paradigm shift and you're investing based on narrative versus earnings power, cash flow, predictability, it's okay as long as you know the game you're in. But if you're buying it just because it's going up and you don't understand that at some point that cash flow has to justify the price, when the music stops, you better make sure you have a chair because it could be very lonely if you don't.
You said a key word in there. You said Momo stock?
Momentum stocks.
Momentum stock.
Yeah.
Momentum stock.
So how do you find those diamonds in the rough?
Yeah, how do you get
necessarily?
underneath there?
Like, should you be looking at the equal weighted index, or how do you find the stocks that maybe are a little bit undervalued or not performing as well? Because, like you said, it feels like the attention is on these Mag 7s all the time.
Yeah, that's a really good question. What we look for at Great Hill Capital is divergences between the underlying fundamentals. So if we can buy a business where the free cash flow is going up every year and the price has come down a lot, we want to find out, why is there this divergence? Is it cheap for a reason and it's going to stay cheap, like a value trap, and it's never going to go up because they've lost share or their technology's outdated or whatever? Usually when their cash flow is going up and the price is going down, in the short term, the market is a voting machine based on emotion, meaning people are saying, I can't buy that because the stock keeps going down. Not, I can't buy that because the free cash flow is going up. In the long term, it becomes a weighing machine. Sooner or later, that stock price is going to catch up to the underlying fundamentals, which are improving, like we saw with Alibaba, like we saw with Intel, like we saw with ExxonMobil and others. So when you can find those, it's not just about getting a stock that goes up. It's about sleeping like a baby at night because you know the underlying business is secure, predictable, has a moat, has a long history, a long track record that you can measure against. And you don't have to worry about them missing 1% because they have free cash flow generation. They're trading at a reasonable multiple. And sooner or later it catches up. And when they do, they're doubles and triples. They might not be 50 baggers like the story stocks, but the 50 baggers quickly turn into 80% downs.
For those three stocks that you just mentioned, like Alibaba, for example, is up nearly 100%. There may be some people listening out there who say, oh, maybe they'll continue this momentum. What would you say for people who are thinking, is now still the time to get in?
Yeah, well, in the case of Alibaba, it was so cheap that we have not sold a share of Alibaba. We do think it's going to go up quite a bit from here, but it's going to take 3 years.
Right.
This could be a mid 200s, low 300 stock, and depending on how the AI story plays out, because they control e-commerce. They control the cloud business, which is in their more nascent stages than in the U.S. Think Amazon Web Services of China.
Right.
And you have a lot of outs, and they have all these businesses. 33% of Ant Financial, largest financial services business in Asia, has 0 credit in the stock right now. And then the AI could be truly unlimited. They're galloping, triple-digit growth year on year. So that one could double again.
Do you have any picks for us? I guess we were just talking about sort of those companies that maybe you can find opportunities in.
Yeah.
Do you have anything that you're bullish on right now?
So this one's going to take, again, 3 years. One of the ones that cash flow has been near records, revenues are near records, the stock price is still down 78%, is PayPal. You can't give it away. Alex Chris came from Intuit. He ran the small business division. Intuit was a multi-bagger under his leadership at that company. He's come in. He's doing innovative things with Venmo. He's getting the transaction margin up. He's in stablecoins, 6th largest issuer of stablecoins. He's at the cutting edge. I think he's going to do tremendous. They kind of troughed in active users. Now they're starting to reaccelerate. Margins are starting to reaccelerate. So this is a company where the stock's down 78%, record free cash flow, record revenues. That price, when this thing turns, it's going to be aggressive. And what people get sidetracked on and they get sold out of their stock is, they see them report good earnings and the stock's not going up. It doesn't go up until it does. And then when it happens all at once. Baba took a year and a half to build a base. Then it just turned. It went from 60 to 180 basically overnight. PayPal will be no different, and people are skeptical. So you can't give away that stock right now. Everyone wants to chase NVIDIA, chase Palantir, and those might work. You might get an incremental jump, but no one's paying attention to the fact that Intel stock has outperformed NVIDIA this year.
And do you think in order to be a successful stock today, you have to just have some sort of relationship with AI?
Yeah, it's the Wall Street fashion show. Okay, 5 years ago it was SaaS. If you were software as a service and you had recurring revenues, people would pay exorbitant multiples. Now you can't give away a software stock. Look at Adobe; they're in the gutter. No one will even buy them. They're probably cheap at this point. So for the foreseeable future, you're going to hear the word AI on conference calls. Even if they're making donuts, they're going to say we use AI. So the stock goes up.
And then the stock goes up. Exactly.
Yeah. But if you've been around through enough cycles, all of that narrative, all that noise, short-term voting machine, long-term weighing machine, look at what's happening under the surface. And the name of the game is going to be free cash flow, because that's all the reason anyone buys a business. The reason you buy, if you're going to buy a local franchise, why do you buy it? Because it's generating this much cash today. I think it can generate this much cash tomorrow. Therefore, I'm willing to pay this much. If people bought stocks the way that they would buy a local car wash or a local Jersey Mike's franchise, they would do a lot better over the long term. And we saw it from the GOAT, from Warren Buffett, stepping aside at the end of this year. He outperformed the S&P 19.9% per year versus the S&P 10.4% per year. If you'd invested with him, you made 5.5 million % returns. If you invested in the S&P, you made 39% returns, which in English for your viewers means in the S&P, you doubled your money every 7.2 years. With Warren, you doubled your money every 3.5 years.
So nearly half.
Yeah.
Wow. Okay.
Buying boring businesses. And by the way,
businesses, that's a takeaway.
this was the perfect thing, perfect analogy. In 2000, Warren Buffett was on the cover of multiple magazines saying, has Warren Buffett lost his touch? He was underperforming because he had no exposure to the Ciscos, to all the high-flying stocks, the Global Crossings, all the high-flying stocks of the late 90s. The next few years, as the NASDAQ collapsed 80%, Warren Buffett had his best 4 years of performance in decades, up 25%, while everyone else was taken out to the woodshed.
There you go. If you want to invest like Buffett,
Yeah.
sometimes not those sexy names. But Tom Hayes, thank you so much for joining. We are winding things down here at Stocks in Translation, but make sure you check out other episodes of our video podcast on the Yahoo Finance site and mobile app.